Tuesday, March 14th, 2017, Monaco 64, home of alternative economics and contrarian views. So we're only 4 hours ahead of New York up until March 26th when the clocks go forward in London or in the UK as well. So it's 11:45 a.m. I want to talk about the bond market, interest rates, derivatives, and the dangers that volatility in the bond market or volatility in yields can cause to the whole system, financial system, especially with all the events coming up tomorrow with the Fed hiking interest rates and giving their view for the future about the economy and rates. We've got the Dutch elections tomorrow, French elections in April, the situation, geopolitical situation heating up. Just a headline here on Zero Hedge saying North Korea threatens U.S. with merciless strikes as U.S. carriers arrive in Korea, South Korea. So a lot of stuff going on. Interest rates. So I've been looking at the Fed funds rate, the 2-year yield, which is a fairly short term interest rate, which the Fed really doesn't control. The Fed controls more the overnight Fed funds rate target, and also the 10-year yield, of course, because that's a benchmark yield for the pricing of a whole lot of assets, all other loans, all corporate bonds, all other government bonds, all stocks. So the 10-year yield is very important. It's the price, of money for 10 years. So I've got a chart here of the 2-year yield. And what I noticed, as you can see, last year on December 2015, when the Fed hiked interest rates for the first time, in ages, I think it was for the first time in like 8-9 years. I'm not too sure. You can see that the 2-year yield actually spiked a little higher there at the end of 2015, towards the beginning of 2016. But then it just tumbled from I think it was around 108, almost all the way back down to 0.6%. And ever since, the whole of 2016, the trend in the 2-year yield was lower, even though it spiked higher. We dropped in the summer back below 0.6. But since the summer, as you can see, rates have been spiking higher. You can see there also when the Fed, before the Fed hiked in the end of 2016, the yield broke through last year's high. I think it was just around the end of November after Trump's election. And then after the Fed rate hike, it kind of came off a little bit there, below 120. But lately, it's just spiked back up and it's making new highs. And as of yesterday, this starts from yesterday, it was at 137. So what that's telling me is that the market might be forcing the Fed's hand to hike interest rates. Last year, after the hike in late 2015, the market actually did not force the Fed's hand, and that's why they did not have to raise rates until December 2016. So that's one thing I'd have to say here. It looks like that chart looks very bullish in terms of the 2-year yield, which means the price of the 2-year note, of course, will go down. And it looks like the Fed is behind the curve, as it usually is. The Fed really doesn't really set market rates. The market sets rates, and the Fed only follows, as the other chart I want to look at here is the Fed funds rate, effective Fed funds rate. And this is from the Federal Reserve Bank of St. Louis. And the little gray columns are periods of recession. And one thing you can notice is that when the effective Fed funds rate start moving up, eventually when it tops, it's during a recession, beginning of a recession, then it goes down during the recession, and then you get a recovery, and you can see the same pattern going back to the 50s. And right now, the last recession was 08, 09, so it's been a while since we had a recession. You look at the distance between those gray columns, it looks like we're due for one. I guess you could argue, from 1991 recession to 2001, that was about 10 years. So maybe we could go on a little further. But as you can see there, the effective Fed funds rate is starting to spike higher, and also the 2 years spiking higher. That's maybe the reason the Fed and even Goldman Sachs is now saying the Fed's going to have to hike in June and September as well. And maybe they see a recession coming, and they'd rather be at higher rates at a beginning of a recession, so they can cut rates and try to get the economy moving again. Being near zero and a recession would be very difficult to pump the monetary system back up. So that's one thing I wanted to cover. The other thing that is pointing to higher interest rates is the 10-year note. Today, here in London, we touched 2.6277. So that was just a little bit below the high last year, which was around 263. And that's the level everyone, I think, who follows the bond markets are looking for. And am I saying that the bull market, 35-year bull market started in 1981, is finished? Not necessarily, because you could have rates go higher, and then if we do have a recession, we could turn back down and break below 130, the 130 yield that we saw last summer. So, or we could zoom up if the Fed is not harsh enough, not hawkish enough, and it's way behind the curve. We could see the longer end spike higher, and the end of the bull market in bonds. And why is all this important? Why am I talking about interest rates? Well, derivatives, which are basically bets on financial assets like stocks, bonds, interest rates, which is part of bonds, of course, commodities. They're just side bets, and this market since the 90s is mushroomed, especially the over-the-counter derivatives. The exchange-traded derivatives, they've been around since the 19th century with agricultural commodities, and they're usually they are speculative, but in my opinion, they're based a little more on reality than the financial over-the-counter derivatives. And these things have grown massively. Right now, well, I think at the top of the last bubble, 2007-8, the Bank for International Settlements said that the notional amount of derivatives was about 1.4 or 1.2, I'm not too sure, quadrillion. So that's 1,000 trillion. You can't even imagine how huge that number is. The investment banks who deal in these derivatives for their clients and amongst each other, they say it doesn't matter the notional amount because Goldman Sachs' long position in a derivative is, in one derivative is netted out against another position, and the notional amount doesn't really matter because they pay a small margin. And yes, that that might be true, but when you had the Lehman collapse in 08, the counterparty risk of these derivatives came to the fore. So even Goldman Sachs, if AIG hadn't been bailed out by the U.S. Treasury to the tune of $150 billion, Goldman Sachs had some positions in derivatives where they're supposed to have, hit the jackpot. But their counterparties were all going, broke. So they were going to go broke as well because they thought they're going to make billions and they didn't. But of course, the US government came to the rescue and paid Goldman Sachs 100 cents to the dollar. So when there is a crisis, these derivatives can become very toxic. Well, Warren Buffett said many years ago that derivatives are weapons of mass financial destruction. And I agree with him on that. And why are the interest rates so important? Well, basically, I think over 2/3 of all derivatives are interest rate derivatives. So it's massive. Right now, the BIS, Bank for International Settlements, and the international, bankers, they've changed the accounting. They're marking the derivatives to model. That means they're not marking it every day to the price of the derivatives. They're marking it to maturity or to how much they think it's worth. So the BIS now says that derivatives are worth only like 600, 700 billion. I would say, they're worth a lot more like over a quadrillion. And the problem with these derivatives is that when the market is stable and volatility isn't going through the roof for interest rates or stocks, these derivatives function okay. But when you start getting volatility and the market gets out of control, you could have a lot of accidents. Why? Well, because these derivatives are the people who take positions on them. It's highly leveraged. For example, one of the exchange traded derivatives on treasuries, 10-year note future. It's not OTC, but you will get the gist. You can control, let's say, $100,000 of treasuries, but you only have to put $5,000 down. So it's like leverage 20-1. And I'm sure a lot of the other over-the-counter derivatives designed by the investment banks for the hedge funds are a lot more leveraged. So you can imagine, you get a 1-2% move in an interest rate on the 10-year yield or on Italian 10-year or 5-year or German. It could trigger loads of problems, and it could bring down counterparties. So that's why I'm talking about interest rates, because some people have asked, so what does it mean, interest rates moving? That's what it means. What we need to look at is, let's say, if the 10-year yield breaks through 263, for example, if by the end of the week, Friday, this coming Friday, it's jumped above that level and it's gone straight to 3.15, that's bad. But if it's gone over 263 and it's 267, 268 under control, that's okay. So we need to keep an eye on for spiking interest rates. That could cause a lot of trouble throughout the financial system, because bonds are a much bigger market than the stock market. Government bonds, all the derivatives on interest rates. So yeah, that's what I wanted to talk about. I'll be keeping a close eye on the 10-year yield and all different interest rates to see if things are, getting out of control or not. So if you enjoyed this video, give me a thumbs up, share it far and wide. If you haven't subscribed to my channel yet, please do. If you'd like to donate to my channel, there's some links below in the description. I'll talk to you later. Bye.